Welcome to the Finance Village podcast, where we navigate the dynamic relationship between financial professionals, their industry, and the clients they serve in an ever-changing landscape. Let's begin. Hi, everyone. Welcome back to the Finance Village podcast. We have my co-host here, Sean Adeyemi, financial planner and mortgage advisor, and your host, myself, Sheldon Bro. And our topic today is financial planning for millennials, preparing for a better future. We're going to be trying to address some of the unique financial needs and the challenges. But we're going to start off, because I don't think everybody always really realizes this. And I think sometimes when people ask me what generation I am, they feel like I'm trying to sneak my way in. But according to ChatGPT's most updated version, millennials, also known as Generation Y, are typically defined as individuals born between 1981 and 1996. This can vary slightly depending on the source, but generally accepted years are 1981 to 1996. So I slide in on their 1981, and typically 28 to 43 years old, which of course I am 43 years old.
Typically don't like calling myself a millennial because I guess when I think millennial, I think of those who were born maybe 85 and up. So they're usually in their mid-30s. But I guess I could be a millennial too. I'm 40.
So you were trying to avoid it. I was trying to sneak in.
No, I was trying to avoid it because...
Okay, so we're talking to our own people then. We're both millennials. Okay, so we're authorities in the space. I'm a senior millennial. What's your birth year?
I'm 83, so I'm 41. So I'm just right on that end of the millennial curve as well.
But let's start with just kind of quickly give our own backstories. Let's try to be a little candid. Let's try to be a little vulnerable for people. People are, always looking at other people and kind of, wondering the situation. Let's share some stuff about our own experiences that we've had in our own kind of financial journey in our younger years until now.
When I think about my journey, getting to the workforce. Even let's even back up to university. I graduated 2006 university, and I remember one of the biggest challenges I had was the amount of debt that I came out of university with. First is OSAP, obviously, as first generation Canadian. I didn't grow up here. I came to Canada in the 2000 actually. And so I did grade 12 OAC. I was the last cohort of grade 13, if anybody remembers that. And new immigrant, had no idea what credit was. And I remember being on campus and you had all this kiosk and say, you want to get a credit card? Had no idea what those were. So obviously I got a credit card and it's free money. I'm in university. I love to party. I love to have fun. And add my OSAP debt and add those credit card debts. Before I knew it, I was $15,000, $20,000, $30,000, $20,000 in debt before OSAP. So for me, that was one of the biggest mistakes, is just not knowing what credit was, knowing how to handle it. And then finishing university and have this huge debt load. If I could rewind the time, if I could rewind the clock, I wouldn't get into so much debt. OSAP was inevitable because I didn't have rich parents. I needed to go to university.
The debt was mostly from school, correct?
Was mostly from, I'll say half and half. Half was school debt and half was just stupid debt. Debt that I didn't need to go into. It was just spending, I remember back then Walkmans were a thing. Those big Walkmans that you put CDs into. Most of the guys don't know what that
is. Always had one. So then you went into the corporate world, and then you went self-employed, or you were always self-employed?
I went into the corporate world for 2006 for about 2-3 years. The plan back then was to go into law school. But what actually made me pivot, which is a good segue, was just realizing how much debt I already was in. My OSAP debt was $20,000.
The fear of debt changed your life goal to be a lawyer?
No, seriously, that's what happened.
Into the impact. This is valid. I'm not like, right? This is the impact it has on us, right?
Right. $20,000 in OSAP debt. $20,000 in credit card debt. And I looked at law school back then will have cost me about $20,000 a year for 3 years. So that's $60,000 additional debt I would have had to take on.
I've got a little bit of a different, quick, interesting story than yours where, the same thing happened. They were probably giving something out. They were typically giving something out, like a Frisbee or a calculator. Mm-hmm. For me, it was a box of cookies. I was in the superstore. I was in there to get some snacks. Box of cookies. Of course, I want a credit card for box of cookies, and I don't know if I'll get a credit card, but the box of cookies, I'm going to eat that immediately because I'm grown up now and I'm allowed to eat more than two. So I got that $1,500 card, racked that up right away because I didn't have any clue other than I could spend this money. And then when I got it up to $1,500, I had that. And I think I had one tiny other thing for a total of like $2,500 worth of debt. Got terrible advice from a credit counseling agency. Be careful of those. But one gave me advice to do a consumer proposal over $2,500, which wasn't even like, I was in school and I wasn't making a lot at that time. But so silly, right? When I look back, it's just beyond my comprehension. For the strong advice that I would like to give to the younger generations and even those coming out of university is get advice early. And for the millennials, build your team and get your advice early. You're going on a dating relationship with people. You're not just, you want to get a mortgage and all of a sudden you're going to scramble to find a mortgage broker. You have no idea what their skill set is, what their scrupulousness is. You know what I mean? You don't know what you're getting into. Start choosing and filtering these types of relationships early. Quickly explain for us what a Henry is, or whatever you call it in the advisor world, Sean.
That is high earners, not rich yet. That's what we consider Henrys.
And one of the biggest things, again, I'd say is just, don't get caught. Let's go here first. Don't get caught on just all of the hype that's online. There's lots of noise, lots and lots and lots and lots of noise. Just like you go on Instagram or TikTok and it's like, eggs are bad, eggs are good, eggs have cholesterol, eggs are good for you. Eat eggs and your brain will get bigger. Eat eggs and you'll die. And it's like everything is like, good for you. And then, so it's like, unfortunately, we're overwhelmed, we're over inundated. We're living in an era where people have short attention spans and therefore you're pummeled with a bunch of sound bites and it's tougher for you to navigate. So you guys we are all living in a tougher time to navigate financial advice. Stop trying to be cool dudes and do it on your own. There's a lot of people that are you either have to go hard on financial literacy, which you can, or use that time for something else and pay someone for financial advice. There's an opportunity cost or a lack of return on investment.
Even before you add all the bells and whistles, the first thing is have a defined budget. Expenses, income, make sure you're spending less than you're making. That difference, open a simple savings account. It doesn't need to be even a TFSA at this point. It could just be a savings account. You want to have 3 to 6 months of savings in there. Anything after that, once you've gone 3 to 6 months of emergency fund in your savings, it's at that point I would now then look at opening a TFSA, because now you want to start investing. And at where you are, then you can then start investing using a TFSA, because then you have the potential to invest in stocks, bonds, ETFs, and different instruments that can grow your investment tax-free. So that's when I would look into a TFSA.
Let's quickly talk about something super important, something that apply unreasonable amount of peer pressure on people. It's going to kind of combine with another point I want to make, which is emergency fund / insurance. We'll talk about those together in a second. And then easily being swayed. So you want to judge harshly. If you start getting that one piece of advice, there might even be an advisor that's willing to say, hey man, you're in a university. I look at you as, keep me in mind for the planning for the future when you're balling. I'll give you a free half hour. Try to find some financial advice somewhere your earliest years, build that relationship, build that trust. And when it gets to the point that you are making money, you have somebody that you've gained their trust. So again, pocketfinance.com, great place for you guys to find your professionals and look at databases there of people that you want to see if they're a good fit. But don't be swayed easily. Judge everyone harshly, Sean, and that includes the people that you're going to see online on TikTok, Instagram, given the secrets of the rich and all the blah, blah. Some of these people don't have a clue necessarily, or they're missing a lot of nuance. There's just all kinds of advice. And again, the advice is the staple core around advice should be, it depends. Now tell us quickly what your thoughts are from a planner on the emergency fund and then where the insurance to start, because I'm married now, but as a single guy, a lot of the time they don't want to get life insurance. Maybe there's not really necessarily anybody for you to leave it to a spouse or kid, but you should have critical illness not to become the liability. Disability is a consideration, but a little bit more expensive. But having critical illness before I have the emergency fund is quicker and easier, because it's like $30-40 a month. I can instantly be insured for that 75, 100,000, and I've got that level of peace of mind, at least until I get emergency fund up. Talk to us about the insurance and emergency fund relationship.
I would actually submit to you that even though you're not married, you're single and you have no kids yet, to get life insurance. And it doesn't need to be anything complicated. I would stay away from permanent insurance policy at this phase in your financial journey. I would get like a cheap term insurance, 20-year term or 30-year term should suffice for you. And because I generally don't like using rule of thumbs, but I would say you want to get anything around 10 to 15 times your annual income. So if you earn $70,000 a year, you want to get like $700,000, like a term 20 or term 30. The reason why is in 3-5 years, by the time you get married, you've gotten that insurance on a discount, and you already have insurance that can protect your wife and your kids, that by the time you get married and you're a few years into your marriage, you can then review your overall picture again to see how much insurance do we need as a family. But at least you would have gotten a good chunk of it out of the way if you had it early, because you're paying a much cheaper premium at this point in your life. So you want to get term. Stay away from permanent at this stage. You're not there. Well, if you're making a lot of money at a young age, and you're already maxed out TFSAs, RRSPs, then I may consider permanent insurance. But if you don't have a TFSA and you don't have money in your RRSP, you have zero business being in whole life. I don't see how you can make anybody, unless you're selling insurance, how you can make a good argument. I would definitely debate anybody that tells me that you should be getting a universal life or whole life insurance policy when you don't have a TFSA fully maxed out, because a TFSA, we talked about it earlier, your investments are fully tax-free. But when you try to invest using a life insurance policy at this stage, you're paying the cost of insurance. You're paying insurance tax. You're paying a bunch of fees in there that your returns are actually much diluted in an insurance policy, when you could have the full $100, $300, or whatever it is you're putting into that investment fully invested and not through an insurance policy. I'm not against permanent insurance. I have clients that have permanent insurance policies, but most of the clients that do have that already have a good foundation in their TFSAs, their RSP, or even their corporations, where there's a good chunk of money already invested or in those vehicles. So when you're starting out, stay away from anybody that tells you and sells you bells and whistles on how you can use insurance as an investment vehicle. Run away from them. They're just trying to make a big commission.
That's on the life insurance side. Now on critical illness, that's the one. I'm terrified of not having critical illness insurance. I was paying for it for one of my siblings when they wouldn't even get it on their own, because I was like, it's too dangerous not to have that. We need to all have that for that when we qualify, because it covers generally, correct me if I'm wrong, Sean, about 25 of the most common illnesses. One of them, of course,
that's
being
correct.
Cancer, which is that number one. Because I feel like the stats now I feel like I've heard a few times is 50%. 50% of people are going to get cancer at some point in their lifetime. So having that critical illness just feels like that, and to what extent do we have the coverage in the Canadian system? Do you know that about cancer in the healthcare system?
So the three biggest causes of death in Canada are cancer, stroke, and heart attack. And so you want to have any critical illness policy at least cover those three. If you can get, and there are the different types of critical illness policies. There's a simplified issue that would cover like 4 of the top illnesses. And it is the one that you mentioned, which is 25 of the major illnesses. I would get, if you're starting out, I would get maybe like a term 20 or term 30 critical illness. I typically like a term to age 75 with a return of premium, because if I never get an illness between those ages, I get all my premiums back plus a little return on investments. So critical illness, when I'm doing financial planning, is generally one of the things we recommend. And I recommend it with a return of premium, because even if the youngest that I have, maybe 21.
You would recommend, not that you have, but that you're willing to recommend to. Because I feel like at what point, I guess it's a personal choice for the person. So this is the question I'll suggest people ask themselves. At what point do you want to take full responsibility for yourself so that you are not relying on your family for an emergency situation?
I think, yes, that's a legitimate question. The other part that plays into critical illness is, what's your family history like? Because when it comes to critical illness, what your family history, do your parents, grandparents, uncles have a history of
Mine's
some
tip
of those
top.
illnesses,
Mine's tip top,
right?
but I'm taking into account the new
Diabetes,
variables. Food is more poison than it's ever been. Food is
that's
more
true.
poison than it's ever been.
That's
They're
true.
torturing these animals before they feed them. They're not running around free.
It's not just
They're
that. It's
they're
in the
torturing
water.
them.
It's in the sugar. It's in the
Yes.
salts and all the food that we eat. They contain a lot more of these ingredients that can affect our health. So absolutely critical illness as soon as you can afford it, right? So it all boils down again to what are you earning? Do a basic budget where you can put enough away for an emergency fund and you can afford a little bit of life insurance, a little bit of critical illness. Yep.
Financial stress is supposedly statistically the greatest stress that exists over every other stress. The psychological benefits of having advice, coherent advice, not being at a
Right.
10% analysis and calculation of your life decision, but even being at 30, 50, anything is better. And being able to have more confidence and less stress is going to make you more focused at school, statistically.
Mm-hmm.
Going to make your mind have more room to do better on the exams. It's going to make you a better employee. It's going to make you perform at a higher rate to bring in more income, especially if you're at something like a commission or whatever else that we're like, it's not just the hours going by that you're getting paid. And I would even say that even with the hours by going paid, you're doing a better job. You're getting better promotions. The less stress and the more confidence that we have and the psychological benefits of me not having to think about when I'm hanging out with my buddy Sean and his family at a barbecue, I'd like to be like 100% there, if not 75, but I'll take 75 over 50%. I'm able to focus on what I'm having a good time on, and 25% distractive psychological stress of finance. Because when I leave, I'm wondering like, we need groceries, we need milk, and we need gas. And I think I got about like, half of that. People are going paycheck to paycheck. So the psychological benefits of early is again, the cost of opportunity, the opportunity cost
That's
and
right.
ROI on your life quality is substantially more than we give a moment's credit for. And with that, we're going to get into home ownership versus renting. Both of them are convincing to me because I liked renting for a long time. I'm only just buying my first home now at 43. I liked being able to bounce around, not being stuck, not having a headache. I also missed out on opportunities in Toronto. One of my friends bought a place for 380, sold for 650 3 years later. One of my recent clients in Halifax 4 years ago bought at 270 and now cashing out at 550 and traveling the world and closer to her retirement. So, but at the same time, there's a lot of people that have said, I'm running away from this. I never want to have tenants again. Blah, 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 blah. There's good data that really can make it kind of easy to bounce back and forth. So where do you see some of that?
I also think it depends. I think it depends on where you are financially. I think if you can afford to buy, do look into buying, but also make sure that you're not buying over your budget. Like, do not buy at the end of your budget. That's the one thing I always advise people against. Just because you want to buy doesn't mean, just because you're qualified for a $400,000 house doesn't mean you should get a $400,000 house. Always buy below your budget because you want to give yourself wiggle room. So the question then becomes, if I'm ready to buy and this is how much I can qualify for, where am I located? Am I located in the GTA? Does the price point that the prices are going for, do they make sense for my budget? If they don't make sense for your budget, just keep renting and the right opportunity presents itself. As long as you're doing the other things we spoke about before, which is spending less than you earn, have an emergency fund, you're saving and investing. When the opportunity presents itself, you will be ready.
So let's summarize and keep this one short. Whatever we need to do, we want to get that emergency fund as a bare minimum. Look at getting some of that, insurances in place at a younger age, if it makes sense after, talking to different people so that you can have something available if any emergency does happen without the emergency savings. And be careful about taking on those max payments on mortgages and vehicles. These are some of the core precedents that, if we wanted to leave you with a simple conversation, I think is very meaningful for those that are our age right now, and certainly looking at some of those younger people coming out of university.
Quickly summarize it. One of the things that just crossed my mind that we do for our clients, this is a shameless plug, but I think it's a good plug. If you are in the GTA, you earn a really good income, and you're looking to get into home ownership, and you already have a little bit of down payment, but are struggling to get the difference, I have a program for you. I have a program that will help you secure the remaining down payment to get into home ownership, as long as it makes sense for you financially. It's a neat strategy that doesn't require monthly payments or anything, but the idea is if you can get at least 5% of your own sources, we have a program that will help you get to the remaining 20%, which would reduce your mortgage payments, which will help you avoid the mortgage insurance when you put in less than 20% down, but will allow you to get into real estate market now, start building equity, and then use your home to pay back that program to help you get into real estate. So that's something we do for new homeowners. Because let's face it, if you're living in the GTA, you may earn a really good income, but the challenge for most people is, how do I get a down payment to get into a house that I can afford?
We hope that this has been valuable. We're trying to make it more consumable for you, and you want to go for all professionals that want to be able to have a permanent place, no matter what brokerage, no matter what MGA, no matter what different place that you're housing yourself at this moment in time. financevillage.ca. Sign up for the wait list. This is going to be a place where you can have a permanent home with professionals that are in your segment, but also interacting with some of those that are outside of your segment. And thank you for being a member of Finance Village. 92% of people trust referrals from people they know. But there's a better way to make those introductions. Wrap your arms around your client with your professional team. Join your client's team free today. PocketFinance.com.